Relying on a chatbot without live data checks turns your portfolio into a playground for dangerous hallucination. I ran Singtel through a general AI tool to test its dividend safety, and the answer that came back looked completely convincing. Then I ran the same numbers against primary filings, and the AI failed on the single most important yield threshold in SGX income investing. When I ran that test on Singtel, the polish of the AI's answer nearly made me skip my own checklist. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips: the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. We start with the core question staring every retail investor in the face today. Can an AI stock analysis tool genuinely replace forensic due diligence on SGX income securities? To test this, I pitted a general AI tool directly against primary balance sheet filings. The result was a massive gap between algorithmic confidence and balance sheet reality, requiring a strict four-step forensic verification framework to fix. Looking at the danger of unverified AI analysis, relying on a chatbot without live data checks turns your portfolio into a playground for dangerous hallucination. The risk occurs when AI labels a dividend yield as fair without auditing whether income is organic. The direct exposure is your hard-earned retirement capital left vulnerable to unpriced capital risk. Turning to why this matters for SGX investors. Whether you are managing long-term SRS capital or evaluating dividend names for retirement drawdown, unverified algorithmic outputs can quietly undermine financial security. A polished AI narrative can appear entirely convincing on the surface, right until you audit the primary filings yourself. Here is the audit experiment I ran. I submitted a plain query to a general AI chatbot with no live data connection, asking it to analyze Singtel, evaluate its dividend sustainability, and give me a summary of its debt safety. The AI response praised the defensive balance sheet, cited a headline yield of 4.1 to 4.5%, and declared a verdict of fair with capital growth upside. But forensic reality reveals a glaringly obvious gap between algorithmic confidence and balance sheet truth. Examining the headline failure on the yield hurdle gap at 4 Singapore dollars and 42 cents as at 27th of July 2026, Singtel's trailing payout of 18.5 cents equals a headline yield of 4.19%. The AI verdict accepted 4.19% without question, calling it fair. The forensic verdict is an immediate fail because 4.19% does not clear the mandatory 4.7% minimum yield hurdle. Looking closely at why the 4.7% yield hurdle exists, the logic is exact. The 4.7% hurdle equals our 3.2% forensic floor plus a mandatory 150 basis points risk premium. A headline yield of 4.19% simply does not compensate an investor for holding equity risk versus risk-free or policy-protected benchmarks. Here is the full yield deconstruction for Singtel. At 4 Singapore dollars and 42 cents, the 4.19% headline yield fails our 4.7% hurdle. When you strip out the 5.1 cents value realization dividend, which represents a 1.16% component funded by asset monetization rather than recurring operations, you are left with a core organic payout of 13.4 cents. That means the core organic yield is actually just 3.03%. Unpacking the VRD problem and what the AI missed, the tool identified 5.1 cents as value realization dividends but completely failed to calculate the underlying organic yield. Value realization dividends are funded by asset monetization, not recurring operational cash flow. The stripped reality is 18.5 cents total payout less 5.1 cents VRD equals core organic payout of 13.4 cents or 3.03% organic yield. Comparing 3.03% against the CPF special account, a core yield of 3.03% sits well below the 4.0% policy-protected CPF special account benchmark. Calling a distribution fair when the core operating business yields less than a risk-free CPF-SA account represents a structural breakdown in analysis. Moving to the secondary blind spots on debt metrics, beyond the yield failure, the AI generated specific, highly confident data errors on key balance sheet metrics. On net debt to EBITDA, the AI claimed 2.1 times, while actual FY 2026 filings show 1.30 times including associates. On S&P credit rating, the AI claimed A+, while the actual rating is a stable. On interest coverage ratio, the AI omitted it entirely, whereas the actual primary filing shows a pristine 19.0 times. Breaking down why each error matters, the AI invented a leverage ratio of 2.1 times net debt to EBITDA that is not grounded in any reasonable reading of Singtel's disclosures. It got the credit rating wrong at A+ versus A stable, where a single notch affects long-term refinancing assessments. Crucially, it skipped ICR entirely, and a tool that skips coverage checks cannot flag dangerous debt loads in weaker companies. To fix these algorithmic blind spots, here is the 4-step forensic verification framework. Step 1 is the solvency audit. Step 2 is valuation reality. Step 3 is the income stress test. Step 4 is peer benchmarking. Detailing step 1, the solvency audit, we check 3 core thresholds: gearing under 35%, ICR above 4.0 times, and net debt to EBITDA under 5.0 times. To find the data, download the latest financials from SGX Links or Investing Pro. On the balance sheet, divide total gross debt by total assets for gearing. On the income statement, divide operating profit by finance expenses for ICR. On the cash flow notes, verify net debt versus adjusted EBITDA. Looking at the stress test buffer, we audit for the storm, not just the sunny day. While the T-bill rate sits around 1.50% as a temporary market dip, our standards do not lower to match it. Our forensic floor remains anchored at 3.2%, calibrated to withstand a return to long-term average interest rates. That establishes our minimum hurdle of 4.7%, combining the 3.2% floor with a mandatory 150 basis points risk premium. When auditing debt safety, never accept vague AI solvency claims or summaries that say low debt without explicit numbers. If ICR is skipped entirely by the tool, calculate it manually by dividing operating income by net interest expense. A high headline yield with an ICR dropping toward 3.0 times is a distribution cut waiting to happen. Moving to step 2, valuation reality, we calculate the forensic gap, which is the percentage difference between current market price and verified fair value. AI tools frequently confuse market consensus price targets with true balance sheet fair value. Trading at a premium to fair value while yielding below the risk hurdle is a structural warning signal, not a buying opportunity. Expanding on why a premium price plus sub-hurdle yield equals danger, pull multi-model intrinsic value from Investing Pro and compare directly against current market price. The warning signal to watch for is a high headline yield combined with a price above fair value, which means capital growth is constrained and distribution income is vulnerable. Investors end up paying up for perceived safety while accepting inferior risk-adjusted cash flows. Turning to step 3, the income stress test. AI tools treat all cash paid to shareholders as identical, conflating asset sales, capital recycling, and sponsor top-ups with permanent operational earnings. You must ask the diagnostic question: is this distribution funded by recurring operating cash flow or by non-recurring asset sales? Here is how to run the stress test in practice. Open the statement of cash flows, compare distributions against operating cash flow, and assess true yield sustainability. If total distributions exceed 100% of free cash flow from core operations, the yield is artificially engineered. Applying the stress test directly to Singtel, out of the 18.5 cents total payout, deducting 5.1 cents of VRD from asset sales leaves a core organic distribution of 13.4 cents, yielding 3.03%. What the AI missed was claiming a 4.19% yield is sustainable without flagging that over a quarter of the payout depends on continuous asset sales, misleading retail investors on income durability. Taking a step back for Iggy's insight, headline yield feeds your ego, but organic yield pays your bills. The single step retail investors skip is auditing organic yield versus special distributions, and AI models repeat this exact mistake by reading headline totals without auditing cash flow notes. When an asset sale inflates your payout, that is not income, it is capital return disguised as yield. Moving to step 4, peer benchmarking, an AI tool might call a leverage ratio acceptable in isolation, but peer benchmarking reveals whether that balance sheet carries hidden risk relative to sector competitors. To execute, select at least 2 direct SGX peers and compare against identical thresholds: yield hurdle, gearing, ICR, and net debt to EBITDA. Reviewing the forensic peer comparison table for Singtel at 4 Singapore dollars and 42 cents, its headline yield of 4.19% and core organic yield of 3.03% fail our 4.7% yield hurdle. However, its net debt to EBITDA to 1.30 times, ICR of 19.0 times, and S&P credit rating of A stable pass comfortably. Cross-checking these against SGX sector peers ensures we do not accept structural underperformance. However, I did not include the peers this time, as this is just an example of how it could be done. When acting on peer comparison results, if a stock fails a forensic threshold that its direct peers comfortably clear, determine whether a structural disadvantage exists. Carrying higher leverage or lower organic yield than closest peers without a steep market discount exposes your capital to unnecessary drag. Synthesizing this live case study on Singtel, Iggy's forensic zone assignment is Zone 4-, caution, The growth red is a fortress balance sheet where the yield mechanic is the sole constraint. Core organic yield fails the 4.7% hurdle by a wide margin, despite clearing every solvency gate comfortably. Understanding what the 4.7% hurdle is benchmarked against, this hurdle is not a literal redirect option for every dollar of personal capital, but a demand for fair risk compensation when holding equity securities. The CPF special account offers 4.0% as the highest quality guaranteed SGD yield in the financial system. Our 4.7% minimum hurdle demands 150 basis points above that policy-protected benchmark. Clarifying Zone 4 minus, this is a timing verdict rather than a permanent rejection of the underlying business. The business itself remains high quality, but at current price levels, the equity market is not offering sufficient yield compensation for long-term income investors. It is crucial to understand how this framework is calibrated. First, it is built specifically for retirement drawdown, meaning an investor with a longer runway before drawing down income may reasonably tolerate the volatility flagged here. Second, regarding capital surplus, capital allocated beyond what is needed to fund retirement drawdown may reasonably be held to a different standard than the drawdown capital standard applied here. Reviewing the final framework scorecard for Singtel, ICR at 19.0 times passes as pristine against the 4.0 floor, and net debt to EBITDA at 1.30 times passes as pristine against the 5.0 ceiling. S&P credit rating of a stable passes as secure investment grade. However, headline yield at 4.19% fails the 4.70% hurdle, and organic yield at 3.03% fails below the CPF-SA benchmark. Reflecting on Iggy's insight, surface data creates false comfort. AI tools excel at summarizing text, but they cannot perform risk-adjusted capital allocation for you. The tool saw a reputable blue chip, grabbed the total payout, and declared it fair, missing that the core business yields less than a CPF-SA account. The consequence is holding assets that look safe on paper while delivering subpar income in reality. You shouldn't be reading this alone. While free subscribers read yesterday's story, Iggy's elite investors get zero-day breakdowns and complete forensic cheat sheets before the market opens. Link in the description below to join us today. Here is what Iggy's elite investors get. Zero-day breakdowns providing the full forensic picture the moment it is finalized before the market opens. Access to the red zone watchlist flagging vulnerable names, and institutional cheat sheets built around this exact 5-layer audit framework. Summarizing our strategic considerations, first, audit all AI yield claims by deducting non-recurring special distributions and asset sale proceeds to establish true core operational yield before committing fresh capital. Second, enforce the 4.7% yield hurdle, rejecting equity income opportunities that fail to provide 150 basis points above the 3.2% forensic floor. Third, manually verify leverage metrics on primary sources. Always cross-reference AI-reported debt ratios against Investing Pro or SGX primary filings, and never rely on fabricated leverage figures from automated chatbots. Here is my challenge to you today. How many of your holdings actually clear the 4.7% organic yield hurdle? Run your dividend portfolio through this 4-step verification framework today. Looking at the 4 steps at a glance: solvency audit, valuation reality, income stress test, and peer benchmarking. Every AI-generated stock claim must clear all 4 steps before you commit capital. Executing this 4-step verification framework ensures you can independently audit any AI-generated stock analysis, stripping away automated hallucination to expose true balance sheet health. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.